Hello and welcome. You're watching live session on the economic outlook for India, powered by Investonomics and initiative by ICICI Securities. We all know that food and energy are the main drivers of inflation in the current scenario. Since the start of last year, the average contributions just from food exceeds the overall average rate of inflation globally during 2016 and 2020. Energy costs are on rise. Severe inflation, services inflation has increased in the United States and the euro area. Central banks are busy hiking interest rates. How is India positioned on the global map in light of the tighter monetary policy, which will inevitably have economic costs? To talk on all this and more, joining me now is Mr. P.K. Basu, Chief Economist at ICICI Securities. Welcome, Mr. Basu.
Thank you, Geeta. Good evening.
Very good evening. Let's start with the breaking news, sir. Fed hikes rates by 75 basis points. The Bank of England hikes by 50 basis points. Fed chairman points to, indicating that there's more pain ahead. What is your view? When is it going to start?
Well, I think finally, with this FOMC meeting, the Fed has grasped the nettle and has recognized that it made a massive policy error late last year and early part of this year. And it now needs to really aggressively reverse that policy error by raising interest rates quite aggressively. So they've now done 3 consecutive 75 basis point hikes. And they've telegraphed through the summary of economic projections of FOMC members that they will do another 75 basis points at the next meeting and a further 50 basis points at the final meeting of the year. So that will mean that in the course of this year, the Fed would have raised interest rates by 4.25 percentage points from effectively near zero. So they were at 0 to 25 basis points at the start of the year. Yes. They will be at 4.375 basis. So they'll be between 4.25 and 4.5% at the end of the year. That is a dramatic change. And it was not a change that was telegraphed at all. At this time last year, the Fed was promising the markets that there would be no rate hikes until 2024. It's a remarkable turnaround. And the Fed got it terribly wrong. Other central banks got it terribly wrong as well. And we are now paying the price. Now, a lot of the inflation globally is very easily blamed on the Russo-Ukrainian war, but that was just the last little icing on the cake. The cake of inflation was baked by the Fed, especially by the Fed, and also to some degree by the ECB, a little bit less so, and the Bank of England. So really the major central banks have had taken their eyes off the ball, and we are now seeing the consequence of very high inflation. Now, of course, with regard to food and fuel inflation, what you began the conversation with, it is true that those two were significantly a consequence of the Russo-Ukraine war, given the fact that the world's biggest exporter of wheat is Russia. The 5th biggest wheat exporter is Ukraine, and Ukraine is one of the largest exporters of sunflower oil, a major edible oil, and so that, coupled with the fact that Russia is the world's largest used to be the world's largest or second largest producer and exporter of oil and gas, means that those are the areas where inflation has been concentrated. Now, for the U.S. and the Bank of England, there's no excuse because they don't target headline inflation. The ECB does target headline inflation. And so the ECB has an excuse that, look, inflation is really high for reasons that are out of our control. And the RBI, Reserve Bank of India, also has that excuse because the Reserve Bank of India targets headline inflation, and headline inflation in India is being primarily driven by food and fuel prices.
Right.
Fuel prices are largely externally determined, and food prices are, India is self-sufficient in almost all types of food except edible oils. But India is not separated from the world economy. It is linked in terms of trade flows. And when global prices are rising rapidly, there is a huge incentive for farmers to try and export their product outside, especially when world prices of grain rise as rapidly as they rose in the immediate aftermath of the start of that war. So, and of course, unfortunately, the government has had to intervene in export markets. It's very unusual for any government to try and restrict exports. But the countries that have been restricting exports are countries that are abundant in supplies of food and other commodities. So, for instance, if you look around Asia, this year, there is one country that has seen even better export performance than India. India last year, in 2021 calendar year, India's exports were the fastest growing in Asia. This year, India's are second fastest growing. Despite the setback of the last 2 months, one country has outdone us this year, and that is Indonesia. Indonesia is the world's largest producer of thermal coal. It is the world's largest producer of palm oil and rubber. And so when oil prices rise, rubber prices also rise because artificial rubber is made from oil-related chemicals. So from petrochemicals. So all those prices have surged, and Indonesia is sitting very pretty. It is seeing spectacular export growth this year. Now, interestingly, Indonesia was the other country that took the lead, naturally showing the world that if you are an exporter of abundant commodities, then one way to control domestic inflation is to restrict exports, and they did that with palm oil quite early on in April. They relented quite quickly, thank goodness. Thank goodness for us, because we are a big user of palm oil from Indonesia, as an ingredient to edible oils. So, but they showed the way, and unfortunately, India has followed that example and done a lot of interventions in export markets to try and boost domestic supplies of things like iron and steel, petroleum products, which India is a significant exporter of, and even various types of rice. India is the world's biggest exporter of rice. And unfortunately, this year, the monsoons have been very good. I mean, just outside, I've turned my chair to show the pouring rain in late September, rain in Delhi. But the point is that we have a very good monsoon nationwide. Monsoon rainfall this year is 7% above normal. But there has been deficient rain in Bihar, most of Uttar Pradesh, but particularly the eastern and central part of Uttar Pradesh, and central West Bengal. So those are non-irrigation, rain-fed, rice-producing states. And consequently, there are various estimates, but most likely rice output this year will be down. Frankly, it should mean nothing, because India has massive stockpiles of rice. The stockpile of rice is still around 25 million tons. So there is more than enough rice in the FCI godowns to ensure that rice prices can be very comfortably controlled if necessary. But you cannot you cannot you know control market sentiment. You cannot control speculation.
Yes.
And when there are widespread reports of rice output and rice plantings being down this year, markets respond by pushing up rice prices. So we've seen cereal prices rising, we've seen vegetable prices rising. Those are very difficult to control. Fruit prices, fruit and vegetables, milk products. Now, interestingly, milk products, part of the reason why milk product prices have risen is because sunflower is one of the ingredients of grain, but more important is broken rice, the worst quality rice that is not so fit for human consumption, is fed to cows, and consequently, with broken rice prices going up, the gray, I mean the feed for cattle prices have gone up as well, and that has contributed to a pickup in milk and milk product prices. And living in Delhi, I noticed that milk is really cheap in India compared to the rest of the world. but there's been almost a 10% increase. I mean, frankly, it's a small little increase, but it still contributes to the headline inflation. And so broken rice is one of the areas that the government has tried to restrain exports. Now, broken rice is actually used in China as a feed for cows and other animals.
Okay.
And this year, China has had a really bad drought. The Yangtze River, in many parts, one of the great rivers of the world, was almost completely dry. And when you have that sort of situation, there is an extra hunger for imports of grain. And so, all of that has contributed. And of course, the irony is that our other neighbor, Pakistan, has had perhaps the worst flood in at least a century. And it's quite possible that in Pakistan, much of the wheat crop this year has been destroyed, and a lot of the cotton crop has been destroyed. Now, all of that is going to mean that cotton and wheat prices are globally going to stay high for longer, and so it is the danger from food inflation is not over. Unfortunately, in the case of the RBI, so if you look at the August inflation number, I think there was a significant setback. The previous month, the previous 2 or 3 months, we had seen a steady moderation, the headline CPI inflation rate, and then it jumped back up to 7%, just about 7%, but it was a reversion upwards, and that was primarily because of food inflation. So, given that you had this food inflation problem, the RBI has had to act, and one of the actions taken by the government has been to curtail exports of all of those products, but that hasn't sufficed, and so we think that the RBI next week will raise the repo rate by 50 basis points. Now, interestingly, today, Indonesia and the Philippines raise rates. Indonesia, the country that essentially invented the concept of a supply-side intervention in export markets to contain domestic prices, had actually managed to keep inflation below 5%. It's still, inflation is still below 5%, but it's getting closer to 5%, and so they've had to raise raise rates today, almost immediately in response to the Fed's action. And so we've seen a lot of central banks move. The Bank of Japan, of course, was the first one to say early this morning, we're not changing anything. Japan needs inflation. It has been pining for inflation for the last 25 years. And now, finally, they have it. If it's going to come from imported sources, all the better. It doesn't matter. Wherever it comes from is good. Any inflation is good inflation in Japan. And if it then generates a little bit of an increase in wages, an entire generation of workers and salarymen in Japan and salarywomen have grown up without ever seeing a wage increase. They just start a job, they get the wage, and that's it. Wage remains unchanged, for 25 years. Now, this is a remarkable situation, and Japan needs inflation. It needs wage. It needs to start feeling that it's possible to raise wages. So that's the other extreme. I think that's the extreme that many developed economies want to avoid, and I think it's the extreme that China is in grave danger of falling into. Because China has the same demographic trends as Japan did 25 years ago, and so China is a problem country now. It's facing a significant crisis in its property sector, and so it's got a different set of problems. If anything, China is trying to ease monetary policy at a time when the rest of the world is cutting. And so as a consequence of, at a time when the rest of the world is raising rates, China is trying to cut. And as a consequence, the renminbi has depreciated rapidly. It's depreciated about 3.5% in the past year. It's gone past 7.05 renminbi to the dollar. Just a month ago, it was at about 6.8. So we've seen a significant spike up there in the dollar has appreciated sharply against the renminbi. And what that means is that other emerging markets cannot just sit idly by. I mean, India is a competitor to China. We have to let the rupee depreciate a little bit, at least, in response to this rapid depreciation of the renminbi.
That's what is happening. That was my second question to you, Riak. Rupee is now at a record low. 80.28 is the level that it touched in the trade on Thursday. That's today. So where do you see the rupee settling in, say, next 6 months to 1 year?
Well, I think in the next 1 month, in the month of October and probably into the early part of November, first half of November, I expect that the rupee will go towards 81 and perhaps even breach the 81 mark and depreciate a bit further. But I think the important thing is to look around. If you look at the rupee-euro rate, the rupee has appreciated dramatically against the euro. It's appreciated dramatically against pound sterling. It has appreciated against the yen and the won, the Japanese and the Korean currencies. And in the past month, it has even appreciated against Chinese renminbi. So it is depreciating against the dollar, but so is everybody else. Now, unfortunately, the change in the Fed's policy stance, basically between the last meeting 2 months ago and the latest meeting yesterday and the day before, the Fed has dramatically changed its stance. It was signaling that September would effectively be the last big rate hike 2 months ago and 3 months ago. And in fact, 3 months ago, the FOMC's projections were that for the end of this year, they would, the interest rate would, the Fed fund rate would be at 3.375%. They are pretty much almost there now already. And they are now telling us that they're going to raise rates another 125 basis points by the end of the year. So, there's going to be 100 basis point more of monetary tightening by the Fed than was projected at the June and July meetings. So that is really significant. And as a consequence of that, the dollar is going to get yet another leg up. And it is, that is terrible news for emerging markets. In general, when the dollar is strengthening, emerging markets take a beating. And quite remarkably, two markets have held up over the past 2 or 3 months: India and Indonesia. Now, Indonesia is held up for the simple reason that it is a massive exporter of commodities. And most of the time, it's even a net exporter of oil. I mean, with oil, it's interesting because Indonesia imports refined petroleum and exports crude oil and natural gas. So, but the point is that it's unlike India. Indonesia is not a big net importer of oil and gas. India is a massive net importer. So India suffers far more from high oil prices than Indonesia does. But now, with oil prices coming off, now as we can see, this very sharp change in U.S. monetary policy is going to cause recessionary winds, and I think that with this much more aggressive monetary tightening, the recession that I was expecting to set in the fourth quarter of 2023 and first quarter of 24 will occur a lot sooner. So I think that the recession in the US will begin. That is, significant quarter-on-quarter contraction in the economy will set in the second quarter of 2023 and last through the rest of 2023. So, so you'll get a longer lasting, about a 3-quarter recession. Purest sign of that is that the yield curve, the 10-year minus 2-year yield curve, has not just inverted, but it's inverted drastically. As of yesterday, it was minus 0.51%. The difference, the 10-year yield was more than 0.5 percentage points lower than the 2-year yield. So that is a remarkable change. And last night, after the Fed's action, after the market had digested, the market took about an hour to digest. Initial impact of the Fed move was a sell-off. Then there was a rally for about an hour. And then once Powell had finished speaking, and as Powell reiterated several times that that the focus is going to be completely on bringing inflation down to 2%, regardless of how much the economy softens. Once the markets had heard that loud and clear, the markets really sold off. So, and it was a sell-off in both equities and bonds. 2-year yields just took off, which means the prices of 2-year bonds fell sharply. 10-year bonds actually held up a little bit better. And that's a classic sign. The fact that the 2-year part of the curve is seeing yields rise, the 10-year doesn't. I mean, that is a classic sign of a recession ahead. And in fact, it's pointing to a pretty early recession. So, and that is the obvious consequence of the fact that there's been a policy error, and it is now being set right through really aggressive monetary policy action that was not telegraphed 3 months ago, 2 months ago, and certainly not 9, 10, 12, 14 months ago. So it was not. I mean, there was no telegraphing of any rate increase. At this time last year, zero, nothing. They were saying 2024. So that policy error is out there in the market. We can all see it. And as a consequence, recession is certain for the US, and it's likely to happen sooner rather than later. So it'll happen by the second quarter next year. So that's a pretty grim outlook for the world economy.
If that's the case, how long do you expect these restrictions put in place by the government on exports to last? And if that these restrictions are going to last?
Yes, there's been a significant impact on the trade balance in the second quarter of the fiscal year. And I expect that the restrictions on exports will gradually be withdrawn. In fact, in August, there was a pullback in the export duties on refined petroleum. And as a result, you saw slightly better export numbers for August. August, refined petroleum products were up a little over 20% year on year. But crude oil imports were up 87% year on year. So that tells you that, well, I mean, that's one aspect. The other interesting aspect of it is that actually, if you look at Brent crude prices, they were up only about 60% year on year in August. And yet, crude oil imports were up 87%. And in fact, if you look at the period from March to August, over that entire period, the average increase in crude oil imports is a lot higher than the increase in crude oil price year on year. There's a gap of nearly 30 percentage points. Now, we also know that India has increased its imports of cheap oil from Russia. We're getting Russian oil at a discount reportedly of $20 to $30 a barrel. In earlier months, apparently in August, the discount was only about $5 to $7 a barrel. But the point is that we were getting it at a discount, which basically means that the fact that we have the value of oil being so high, it suggests that India has stockpiled a lot of relatively cheap oil from Russia, and as we go forward into the next few months, we're likely to see a drop off in India's oil imports in the next quarter, because we've imported probably a lot more than we needed, and a lot more than suggested by the level of the crude oil price, and especially because we were getting it really cheap for a while from Russia. So that's one aspect. The other aspect is, as the markets begin to price in a US recession and a European recession, which, you know, basically Europe is pretty close to recession already. Once the markets start pricing that in, I expect that crude oil prices will fall further to $80 a barrel by the end of next month, and perhaps even lower. So once that happens, the Indian trade and current account balances will automatically improve. And in fact, it'll probably improve a little more than expected, because we've had unusually large volume of crude oil imports over the last 4 or 5 months.
Basu, so you just spoke about recession coming in US, Europe already in recession. So do emerging markets need to stand ready to manage the potential spillover from these globally tightening of policies and the recession fears? And how do they do that?
Well, of course, emerging markets have to take whatever actions they can. And I think we do need to distinguish between India and Indonesia on the one hand, and other emerging markets, because really, quite frankly, these two have held up really well. Vietnam has held up reasonably well too, because Vietnam has a very strong export machine. It has been the single biggest beneficiary of the relocation of of global supply chains from China. In the past 6 months, India is also a major beneficiary of those of the shift of supply chains. So really, these three are the replacements for China. I mean, as global supply chains begin to look for new anchor countries, they're moving out of China and finding anchor in Vietnam, Indonesia, and India. So that phenomenon will continue. And so these three, I think, are relatively isolated and in better shape than other emerging markets. But if you look around the emerging market universe, most of the rest of the world is in really bad shape. More than emerging markets, it's the frontier markets. The frontier markets, the likes of Sri Lanka and Pakistan, and really any country that has participated enthusiastically in the One Belt, One Road or Belt and Road Initiative of China is in a lot of trouble. So, there's been a lot of focus on China's domestic troubles, and those are significant. Those are significant and widening. It's a property market crisis, very akin to what Thailand experienced in 1997, or what Japan experienced in the early 1990s. And so that is one aspect of what China faces. But on the other side, China faces an emerging markets debt crisis that is more akin to what the United States faced in 1990. It's now easily forgotten that in the 1980s, you had the so-called Latin American debt crisis. The Latin American debt crisis occurred because American banks had lent very aggressively to Latin America. And there was a day in September 1990, I have colleagues and friends who worked at Citibank in New York, and in fact, Citibank in Singapore and Mumbai and elsewhere. They said, we came into the office not knowing whether the bank would survive. It was then the world's biggest bank. And we didn't know whether the bank would survive the next week because of the extent of challenges that the entire US banking system faced in 1990 from over-lending to the Latin American emerging economies. And those were, the likes of Mexico, Brazil, Argentina, those were big ones, but all of Latin America, with the exception of Chile, faced a serious banking crisis and external debt payments crisis right through the 1980s, and it reached a crescendo in 1991. Now, this is China's moment of a similar crisis. China now is the single largest lender to all the frontier markets of the world, all of Africa, Pakistan, Sri Lanka, a little bit to Bangladesh. And, India is being asked to step in and rescue some of these countries. I would strongly advise against doing it because China has covenants in its loan terms, which basically have some unique clauses. They have clauses that basically say that if you can't repay the debts to us, if you can't repay the loan that we've made to you, then you have to give us some of the assets as a debt for equity swap, effectively. Now, so China has essentially anticipated that they would have a banking crisis. They would have an external debt payments crisis. And so they've put in these clauses. You see, in the 1990s, debt equity swaps were one of the ways in which the American banks dealt with the crisis. After failing to deal with it for 10 years, then they began to come up with debt for equity swaps. In the case of China, they've already put the clause in. They've already, taken over Hambantota port, as we know very well, but they've taken over Piraeus port in Greece. They've taken over various mines in the Democratic Republic of Congo, and various similar assets that have been handed over to China. Now, as a result, China is reluctant to participate in the debt restructuring. Normally, what happens when emerging markets have a debt crisis is that the debtors, the creditors get together in what is called the Paris Club, and they negotiate a haircut. All the creditors take a haircut, reduce the aggregate size of the debt, and thereby, taking a haircut means that it is a credit event for that sovereign country.
Yes.
So countries are reluctant to make creditors take a haircut. But whatever it is, there's a process of negotiations between creditors and debtors that occurs in the Paris Club. China is refusing to participate in the Paris Club. Now, India is not really a member. India is not large enough lender to emerging markets to be a participant in Paris Club and other debt restructurings. But India is stepping in, and it has lent about $4 billion to Sri Lanka, a country that is beyond the brink. It is already defaulted, and it has an illegitimate government in place at the moment. The president and the prime minister. The president had his own seat in parliament. He was a single seat holder because Wickremesinghe was a big failure in the previous time he was president, and his party lost out. So almost everybody from his party left, and they formed a new party. That party won the second largest number of seats, but that party is led by Sajith Premadasa, the son of former President Ranasinghe Premadasa. And Sajith is holding back from becoming president for the simple reason that he doesn't want to deal with all these problems. So he is letting Wickremesinghe and Gunawardena, who had 2 seats in parliament. Okay, so the president had 1, and the prime minister had 2. The prime minister's father was the leader of the Bolshevik-Leninist party of Sri Lanka. He was actually a Trotskyite. And interestingly, the father advocated that Ceylon should become part of India in 1947. Anyway, so these fellows don't exactly have a whole lot of legitimacy. So I hope that India will be quite restrained in rescuing this country until China has agreed to restructure, that is, take a haircut on some of the loans that it has made to Sri Lanka. It has lent a lot, and it has so far not taken any pain from its bad lending practices. So China has really bad lending practices at home in China, and it's now exporting those bad practices to the rest of the world. And now it wants other creditors to take to basically be in the back seat while China gets the best deals from any debt reform. So it is it's an unpleasant situation, and of course for us, Sri Lanka is a neighbor. Bangladesh is a neighbor. These are important neighbors for us. Nepal is not in so much trouble. Nepal didn't aggressively participate in BRI, so Nepal doesn't have that much external debt. But these are our neighbors, and so we should definitely try and help them, but not overdo it. Is my point. We need to make sure that we don't let China off the hook. We shouldn't lend money to Sri Lanka that it then uses to repay China, which is likely to be happening at the moment.
As I can get it, the entire globe is in crisis, but our markets are resilient, sir. They are holding up despite of the fact that Fed increased interest rates, the Bank of England increased interest rates, and there are expectations that the hike would be sharper going ahead. So, what is holding our markets firm? And do you expect this kind of a move that we are seeing in the markets to sustain for long?
Well, what distinguishes India from most, from pretty much the entire emerging market universe is that India is less leveraged than most emerging markets. So if you look at India's external debt is less than 20% of GDP. And it has stayed that way. In fact, I just looked at the numbers. It's quite interesting that India's external debt quadrupled between 1980 and 1990.
Okay.
It tripled between 2004 and 2014. In the last 8 years, India's external debt has increased less than 35%. So it tripled in the 10 years of UPA 1 and 2, the UPA government. 10 years, it tripled. And then it has hardly grown. It's grown less than 35% in the last 8 years. So, that is the deleveraging phase. That is external deleveraging. And in terms of internal deleveraging, we know that, bank credit growth in India has been just about, has averaged 9% in the last 8 years. Now, for a country that is this large and where nominal GDP is in the latest 12 months, it's grown about 25%. If you have 25% nominal GDP growth and it's funded by 9, 10, okay, now, of course, in the last 2-3 months, there's been an acceleration. Now, bank credit is growing 15.5% as of the end of August. So that's a return to normalcy. But for 8 years, bank credit in India, in real terms, was growing about 2%. It was 7% inflation, 9% credit growth. So inflation-adjusted credit growth was 2%. And so, in effect, India was deleveraging internally, deleveraging externally, and therefore is now in really good shape and able to tide over this period much better than anybody else. And in fact, we're going to see domestic demand. In fact, we're seeing strong evidence of a significant pickup in fixed investment spending funded by this new credit creation by the banks. But in general, if you look at key indicators, things like capital goods imports in the last 3 months, June to August, were up 28.7% year on year. Now, you might say that's a low base effect. Well, they were up 28.7% year on year. They were up 15.5% relative to June to August 2019. That is the pre-COVID period. So it's a significant step up from the pre-COVID period. And if you look at last year was the low base effect. It was up around 40% in June to August last year. So that was the base effect. This year is not really a base effect. This year is a genuine green shoots of a fixed investment recovery. Capital goods output has held up better than other forms of industrial production. Is up around 23% year to date. So in real terms, okay, so all of that is pointing to a recovery in fixed investment spending. We've seen it in the GDP numbers as well. And I think that fixed investment spending will drive the economy as we go forward and enable India to be an outlier in terms of growth. And the markets are now rewarding that. I mean, interestingly, in the month of August, FII net inflows were over $6 billion. And in July, they were up slightly, about $35 million. But the point is that they were up. The previous 9 months, we had massive outflows, totaling about $38 billion in 9 months. And now FII flows have come back. So, even though India's growth will probably not be as strong, I was looking at over 8% growth this year until 3 months ago. Now that there's been export duty restrictions and all of this put in place, plus sharper increases in domestic interest rates as well, and the global slowdown, all of that has led me to lower my forecast for this year for real GDP growth to 7.5%. I think it'll still be 7.5%, driven by the strength of fixed investment spending. And from next month, we should be seeing oil prices coming off as well. And that will provide further tailwind to the Indian economy. So relative to the rest of the world, India is looking really good. Now, when we look just at ourselves in isolation, it's still looking like a tough year. And if you look at things like consumption, consumer goods output, consumer durables, consumer non-durables, they haven't yet gone back to pre-COVID levels. So consumption hasn't actually returned to pre-COVID levels. It is growing rapidly from the slow base, and will continue, I think, to strengthen. But there is that constraint still. I think the other important point to note is that there are significant labor reforms that have occurred in the past 2 years, and they haven't all been notified. And but several states have implemented the new labor laws, and hopefully the consequence of that will be that we'll begin to see significant investments in large-scale labor-intensive manufacturing. There are some signs already. There are some signs of a significant pickup in electronics-related manufacturing. There are some signs of fairly much larger scale textile garments and shoe manufacturing occurring in parts of the country. But really, if the labor reforms are to really have an impact, then they will generate millions of jobs. And when they do that, then we'll really get a powerful economic recovery that brings in consumption as well. So far, the evidence is still very tenuous on that front. But the fact is that we have the right policy framework in place, and a lot of corporates are expressing interest in massively enhancing capex.
Right.
So we've had big announcements by Reliance, Adani, and this week the Economist magazine, which is a notable critic of the current Indian government, came out with an absolutely laudatory article about Tata's, with the Tata Group, by its calculation, by the Economist calculations, is set to invest $90 billion in India over the next few years. So we know of the very large investment proposals that have come in from the likes of ArcelorMittal. ArcelorMittal is looking to invest in a 24 million ton capacity steel complex in Odisha. So just in one state. Now, 24 million tons is a 20% enhancement of the whole of India's annual production. Annual production this year will be just over 120 million tons. And one company, ArcelorMittal, is looking to add 24 million tons of new capacity. So, Vedanta is looking to invest $19.5 billion in a semiconductor and screen glass, computer screen glass manufacturing unit in Gujarat. So, if these major investment plans come to fruition, then we will have a spectacular industrial revolution across the country. And also we have Foxconn, Wistron, and Pegatron, the three major suppliers of components for Apple's iPhone and other products, all ramping up production in various parts of India. So I think we have the green shoots of the long belated industrial revolution. Prime Minister talked in his first Independence Day speech on the 15th of August 2014. He said, "Come, make in India." People did not really come. The simple fact is that, but a pragmatic government is one that responds to setbacks like this. And the setback was not just India's. As I kept emphasizing, it's not just India that saw the setback.
Yeah.
Joko Widodo, the president of Indonesia, was also trying to bring about an industrial revolution. He was also reforming his labor markets. And he also failed to see any benefit. I mean, Indonesia has struggled to grow more than 5%. Real GDP has not really grown much more than 5% in this entire 8-year period. Jokowi and Prime Minister Narendra Modi came to office the same year, and they've had a remarkably similar journey. Indonesia is hosting the G20 summit this November. India will be hosting next year's summit. So, G20 has chosen the right places. These are the two countries that are actually holding up much better than the rest. And as China wanes as an economic story, India and Indonesia will take its place.
Thank you, Mr. Basu, for being with us. I appreciate your time, and it was a very insightful, talking about the Indian economy outlook and the global overview. Thank you for sharing your views.
Thank you. My pleasure. Great talking to you, Geeta. Thank you.
Thank you so much.